The Fed is out of control.
The Fed has gone crazy.
Jerome Powell is not making it easy.
Well, Donald Trump is now making news yet again by describing Jerome Powell, who's the chair of the Federal Reserve, as an idiot and calling on him to resign. Let's have a listen.
A guy in there that with the stroke of a pen could lower interest rates and save us hundreds of billions of dollars a year. But he's a stupid person.
So, well, if he's a stupid person, then maybe an idiot was the person who first appointed him to a position in the Federal Reserve. So what I'm going to do in this video is explain what the Fed thinks it's doing when it puts up rates, and then show why the theory that it invented was made up in the first place, and I think made up is an advisable way to describe it, and then show that the foundations of that theory, which is known as rational expectations, actually contradict neoclassical thinking. And finally stick with me to the end, and I'll nominate some realistic non-neoclassical economists that Trump could appoint to actually run the Fed. And we all know that Trump thinks Obama's an idiot, and Obama is indeed the person who first appointed Powell as a governor of the Federal Reserve in 2011. But who promoted him to being Federal Reserve chair? That was Donald Trump. Here's what he had to say when he did that back in 2017.
Accordingly, it is my pleasure and my honor to announce my nomination of Jerome Powell to be the next chairman of the Federal Reserve.
So what went wrong? Was it the case that Powell succumbed to Trump derangement syndrome in the years since he was appointed? Of course, he was reappointed by Biden before Trump took over again. That's certainly what Trump himself thinks. Have a listen here.
I think we should be paying 1% right now. We're paying more because we have a guy who's, suffers from, I think, Trump derangement syndrome, if you want to know the truth. But he's not good for our country.
Well, in some ways, it'd be better if he's suffering from Trump derangement syndrome than the actual syndrome that Powell suffers from, which I call neoclassical derangement syndrome. Now, Powell's a lawyer. He's not an economist by training, but he follows the guidance of the Federal Reserve economists, who are all neoclassical, and the models that they build to guide the Fed are simply crazy. So what I'm going to do in this video is explain what the Fed thinks it's doing when it puts up rates, and then show why the theory that it invented was made up in the first place, and I think made up is an advisable way to describe it, and then show that the foundations of that theory, which is known as rational expectations, actually contradict neoclassical thinking. And finally stick with me to the end, and I'll nominate some realistic non-neoclassical economists that Trump could appoint to actually run the Fed. Now, what do the Fed economists think they're doing when they're manipulating interest rates? Well, they use what are called dynamic stochastic general equilibrium models to determine how to set the interest rates. I regard these models as neither dynamic nor general, but let's leave that aside and just take a look at how they explain themselves. This is a document that they published back in 2010 to explain what they're doing using a relatively simplified version of a dynamic stochastic general equilibrium model. And the funny thing is, of course, 2010 is after the global financial crisis, which dynamic stochastic general equilibrium models completely failed to predict. And this is actually recognized by these authors in this paper when they say, as you can see here, recently the 2008 financial crisis has highlighted one area where DSG models must develop: the inclusion of a more sophisticated financial intermediation sector. And it also shows why, believe it or not, the economists who run the Fed are clueless about the banking system. I'll do that in a later video. So I want to talk about what the paper itself says is the way these models work. And if you go through and check out the writing here, you find that the key variable that they think determines inflation is inflation. Not inflation at the same instant as now, but the expectations that the public has, not economists, the public has about inflation in the future. And how do they work out what the public expects? Well, yes, they do surveys as well as other work, but in the models themselves, like the one they're describing here, economists assume that consumers form their expectations using precisely the same model that the economists use to model the economy. And here we get how the Fed thinks consumers actually operate. Consumers' household can form expectations about future incomes. We assume that these expectations are rational, meaning that they are based on the same knowledge of the economy and the shocks that buffet it as that of the economist constructing the model. In other words, what they're saying is they think all these equations here, figuratively speaking, are inside your head. Let's have a look at some of them. For maximizing your utility, Lagrangian for working it out, partial differential equations, not in time, but in cross variables, and finally what they call the Euler equation. And that becomes very important. The model assumes you've got the same model in your own brain determining what your expectations are about the future. And they call these expectations rational. Now, what does that actually mean? Well, not only do they assume that you have a model of the economy in your head, which is the same as the one that they themselves use, they assume this model is an accurate predictor of the future. Now, bear in mind, even in this paper, the authors have already admitted that their models completely failed to predict the global financial crisis. Now, why do the economists make crazy assumptions like that? Well, it's because, believe it or not, these economists who work for the government believe that the market economy works best if the government does nothing. So the idea of rational expectations, which I'll get to in a moment, was invented so that these economists could assert that government policy couldn't work because the public would know the impact of those policies before they happened and would act to counter them. But the argument the government couldn't do this became known as the policy ineffectiveness proposition. And it asserts that there was no way that government fiscal policy could work because the public will save when the government runs a deficit and it'll spend when the government runs a surplus, which therefore renders what the government is trying to do ineffective. And this happens, according to one of the inventors of this idea, a guy called Robert Barrow, because, again, assuming if households have these models in their head, households know that higher spending now means higher taxes in the future. So when the government runs a deficit, those households save so that they've got the income to pay those higher taxes at a later stage. This is the sort of stuff that economists write to each other, and nobody gags as a result, but you should gag at stuff like this. It's a ridiculous argument because economists, neoclassical economists, are the absolute prophets of self-interest. So when an economist goes and appeals to altruism to exploit an argument, you know there's something fishy going on. Now, to find that fishy thing, you've got to go right back to the person who invented the idea of rational expectations, a guy called John Muth, back in 1961. In a paper called Rational Expectations, leading with his concept, and the theory of price movements, he rubbished what's called the cobweb cycle, which I won't discuss here, but it's an argument about how prices fluctuate in some markets rather than reaching equilibrium. So he starts with this argument here. I should like to suggest that expectations, since they are informed predictions of future events, are essentially the same things as the prediction of the relevant economic theory. So here's this idea of the theory being in your head when you think about the rest of the world. Now, this is already gaga because in my case, for example, I'm happy to assume that my own models are reasonably accurate about the future because they help me predict the global financial crisis before it happened, and I'm one of only a handful of economists who did that. But I'm not about to assume that everybody in the planet has my model in their heads. That's what's going on here. Now, people's beliefs differ wildly, and if your theory relies upon them all having the same beliefs, especially if they're your beliefs, then there's something seriously wrong with you. And worse still, if you believe your beliefs are also correct and that everybody shares them, then you're not rational, you're mad. And this becomes obvious further on in the paper, just a small distance forward, when he starts to build the so-called logical argument to support the idea of rational expectations. And he says, we use three things. I'm just going to look at the first one. Information is scarce. Anything else that's scarce, according to neoclassical economics, has a price. And if it has a price, then you don't buy all of it. You buy enough of it until such time as the marginal revenue you get out of paying for the advice exceeds the marginal cost of getting that advice. Advice about the future, by the way, which is even crazier still. So the rational consumer should buy information only up to the point that the marginal utility of that information equals the marginal cost. Buying any more than that is irrational. So if you properly apply neoclassical theory to this argument, you would support not this idea of planning for the infinite future that these neoclassicals throw in. It would support the idea of what they call bounded rationality. In other words, he's contradicting neoclassical theory at its core to derive this idea of rational expectations. And this might seem weird, and it is, but the reason it happens all the time with neoclassical economists is they'll flay their logic forward and they reach a brick wall. They can't go any further. So they imagine they can walk through the brick wall and keep on going. Now, this is what I call the can opener assumption. It's a joke about economists, which I was first told by a nuclear physicist in a public auditorium in front of my professor of economics, who I was fighting at Sydney University in the 1970s. So if you haven't heard the joke, it goes like this. A physicist, a chemist, and an economist are wrecked and survive a shipwreck and end up on the same desert island. They've got nothing to eat except cans of baked beans that have also washed up from the shipwreck. The chemist says, well, I can make a fire using the nearby palm trees and I can heat the cans enough to make them explode. And the physicist says, great, if you do that, I can calculate the trajectory of the beans and we can go gather them and eat them. And the Economist says, oh, hang on, guys, you're doing it the hard way. Let's assume we have a can opener. Now, if you like more jokes like that, click on the link in this video and get hold of my Funny Money Bundle. It's free this week on stevekeen.com, and scan the QR code on screen to get your copy. Now back to the bad joke that is neoclassical economics. It should be obvious that a model based on nonsense like this is not going to work, and that's the case. The authors themselves admit it. So you take a look again at this paper and you find them saying precisely that. The failure to match the data highlights the main empirical weakness of our paper. It's, as in most of the DSG literature, so it's not just a simple model, it's all the models the neoclassical economists put together. They've got an Euler equation. I won't bother explaining why they insult the name of a great mathematician to use this thing here. So standard specifications provide an inaccurate description of observed relationship between growth rate of consumption and financial returns, yada, yada, yada. Okay? It's something which basically says, look, the model's crazy. Rather than admitting the model's wrong because the Euler equation is a fantasy and it should be thrown out, other modeling approaches should be used. They say improving the performance of the current generation of GSG models in this dimension would be an important priority for future research. The really important priority is to throw DSG models in the garbage bin and build genuine dynamic models of how the economy operates, dynamic general models that can be built with my Ravel software that you'll see in the work of Tyrone Keynes in particular. And if you go and look at people who've done realistic work on economics outside the neoclassical paradigm, then there's the great Polish engineer turned economist Michał Kalecki, and working from economic definitions, he derived three main drivers of inflation: change in money wages, change in output per worker, and change in the markup that firms apply on top of money wages. So his final formula was that inflation equals the sum of the changes in money wages plus the changes in markups minus the increase in output per worker. And you can put that together in my Ravel software and you'll get something like this, showing what's happened with both inflation, money wages, markups and labour productivity over the post-war period. And if you take a look at the data, you can see that there are periods where, certainly the 60s and 70s, the rate of increase of money wages exceeded the rate of inflation. So real wages were growing. Markups went up and down all over the place, sometimes rising, sometimes falling. The increase in inflation in the 1970s was largely driven by a decline in output per worker, and that was associated with the increase in energy costs. And you can replace wages with energy and get the same sort of analysis out of this. So that is something which shows the importance of costs that capitalists can't control, energy on one hand, wages on the other, in setting inflation. Then you get past the 1972 period and you now see a sustained period where normally the rate of inflation is greater than the increase in money wages, so real wages fall. And then from the 90s on, you have periods where the markup grows more rapidly, and then both prices and wages, sometimes it falls, but a lot of the inflation here is due to changes in markups. But let's narrow in and just take a look at the inflation around the COVID periods. Let's drag this is Ravel, by the way, my analytic data analysis software that you can get from patreon.com/Ravelation. I released the mouse there, and now I can see the rise in inflation from 2% before the crisis, and actually even during the beginning of the crisis, inflation was below 2%, then rising up to 6%. Now, a large part of that was driven by money wage growth exceeding the growth in the level of inflation, and a lot of this you can track back to the government stimulus, with the scale of the deficit being run during those years, which stimulated demand, of course, the opposite of what neoclassicals will tell you. But then the main factor was the labour productivity here is reducing inflation until 2021, and then we have this decline in labour productivity, which turns up as an increase in this negative here. And you find that ultimately a major cause of the inflation we experienced during COVID was a decline in output per worker because of all the supply bottlenecks. So you can't address that by putting up the rate of interest. It's simply silly to focus on that and see that it's the only thing that's changing inflation. But that's because they don't even look at factors like this. They think it's all expectations in your head, which is full of their fairy dust models of the economy. Nonsense. You see, this is now the dilemma, because Trump thinks it's just one person, Trump derangement syndrome, but it's the entire profession of mainstream economics. If he appoints anybody from background, we'll get the same results as Powell. He'll praise him when he appoints him and be complaining a year or two later that he's not reducing the rate of interest. He's not reducing the rate of interest because of fantasy ideas in his heads. Now, what we need are people who are realistic about how inflation is caused. And I can nominate a few of them for you. Most important is Isabella Weber. Isabella is a professor of economics at the University of Massachusetts Amherst, and she's specialized in looking at what causes inflation. And she's one of her many guidances out of this is that a major way to address inflation is to have agreements between workers and capitalists over wages and prices to avoid those wage price spirals in the first place. Another person who does brilliant work on this front is Blair. I've just hired him and get him to come inside. This is Blair's website, and he does quite brilliant empirically guided work. He's probably the most empirically driven economist I've ever met, and he's completely free of all the hang-ups of neoclassical economics. So he goes in and says that inflation is a distributional factor. It's the impact of varying price increases on different segments of society that really determines the impact inflation has overall, not just the one number. And there's a third entry. Now, unfortunately, he's an Australian living down in Brisbane, James Young. James has actually taken my work on the role of credit in causing booms and busts and turned it into an explanation for inflation, because fundamentally the private money system creates most of the money in the economy, and this is the large thing that gives us the elasticity of the financial system that is part of why you do have bouts of inflation on occasions. Any of those three would be far better than Powell and far better than any person who could be appointed who believes in neoclassical economics. You don't want people with fairy dust in their brains determining economic policy. That's what we've got at the moment. But be careful about getting too focused on reducing the rate of inflation to zero. This is data from the Federal Reserve showing the price level over the last 200 and something years, from 1800 through to today. And you can see, if you look at this chart, the normal reaction people have, oh, look at the inflation since the Fed, which occurred back in 1913, and World War II has occurred. Terrible inflation here. Prices were much more stable back in the 1980s. Well, no, they weren't. Because if you drill in on this data, and I'll do this over here, let's just add a caliper. And what you see is the price level would go radically up and radically down. This is not just you had periods of massive inflation, but you also had periods of massive deflation. And that deflation was normally accompanying financial crises. There was a serious financial crisis in the 1800s, pretty much every 10 to 15 years, causing immense pain and hardship. So be careful what you wish for. If we got ourselves back to the situation of the 1800s, we wouldn't have price stability. We'd have price instability, bouncing up and bouncing down during booms and bumps, adding the toxic power of deflation to problems with excessive levels of private debt at the same time. So let's be realistic. Yes, inflation matters, but keeping it to reasonable bounds, not trying to hit a rigid target of 2%, is far more rational than what neoclassical economists are doing today. So Trump, it's not derangement syndrome of you that matters, it's the derangement of believing in neoclassical economics.
If you're like many other truth seekers and want to learn 50 years of real economics from me in only 7 weeks, you'll love my new 7-week Rebel Economist Challenge as well. To apply, go to stevekane.com. If you qualify, you can attend my lectures, ask me questions personally every week, and make friends with a great group of like-minded people. So again, like many others, go to stevekane.com to apply as well for the 7-week Rebel Economist Challenge. Good luck.